Welcome to the Explainer. It seems simple, but have you ever wondered how a business really knows if it's making money on something? It's not just sales minus expenses. Today, we're diving into the secrets of cost accounting, and we're going to show you how truly understanding your costs is the key to unlocking profitability. It seems like such a basic question, doesn't it? But the answer is actually pretty deep. It goes way beyond just looking at the sales numbers at the end of the month. The real answer? Well, it all comes down to one thing: mastering your costs. I mean, really knowing what they are, how they behave, and how every single decision you make impacts that bottom line. And to make this all crystal clear, we're going to use a really simple example that we can all relate to: a local bakery. By following along with them, we're going to see exactly how a business can measure, manage, and use its expenses to figure out the real story of its financial health. Okay, so first things first. Before we can even start to manage costs, we all have to be on the same page. Let's define what we even mean when we say the word cost. A cost, it isn't just the money that leaves your bank account. It's really the value of any resource you give up to get something done. That could be money, sure, but it's also materials like flour or even something as valuable as your employee's time. All of it is a sacrifice to achieve a goal. And that thing we're trying to measure the cost of? Well, in the accounting world, that's called a cost object. This could be anything. It could be a single loaf of sourdough bread, a big corporate catering customer, or even the entire marketing department. If you're asking, is this thing profitable? Well, that's your cost object. This visual right here, it perfectly illustrates the whole cycle of a business, really. You have your economic resources, think flour, sugar, labor, that all flow into a cost object, like a croissant. And the whole point, the whole game, is for that croissant to then go out and generate more income than the value of all the resources it just soaked up. Okay, so we get what costs are, but you can't manage a giant, messy pile of expenses. It's just noise. The key is to sort them. And there are two really powerful ways to organize them that let us see patterns. Patterns that are absolutely crucial for making smart business decisions. So, the first way to sort them is by their behavior. You've got your variable costs. These go up and down with your activity. The more bread you bake, the more flour you use. Simple. Then you have fixed costs. These guys stay the same no matter what. The bakery manager gets the same salary whether you bake 10 loaves or 10,000. And when you look at it on a graph like this, it just clicks. See that rising line? That's your total variable cost. As production goes up, the cost goes up. And that flat line? That's your total fixed cost, just humming along, completely unaffected by how busy you are. But here's where it gets really interesting. A little bit of a twist. If we look at these costs on a per loaf basis, the whole thing flips upside down. The variable cost for one loaf, the flour or the yeast, is actually fixed. It's the same for every loaf. But the fixed cost per loaf goes down the more you bake, because you're spreading that one manager's salary over more and more units. Now, the second way we sort costs is by traceability. Is it easy to connect the cost to the product? A direct cost is easy. You can trace the cost of chocolate chips directly to your chocolate chip cookies. But an indirect cost is shared. Think about the electricity bill for the oven. That oven bakes bread, cookies, muffins, so how do you assign a piece of that bill to each one? That's an indirect cost. Okay, so this is where everything we've just talked about really comes together, because how we classify all these costs leads to two fundamentally different ways of calculating profit. You can almost think of them as two different philosophies, and each one tells a very different story about how the business is doing. First up, you've got absorption costing. This is the method you have to use for your official financial reports. It absorbs all the manufacturing costs, variable and fixed, right into the value of the product. Then you've got variable costing. This is a tool for managers, for internal decisions. It says, nope, only the variable costs actually belong to the product. The fixed costs are just the price of opening the doors this month. So here's what an income statement looks like under absorption costing. You start with your sales, and then you subtract your cost of goods sold, which, remember, includes both the variable costs and a slice of those fixed factory costs to get to a number called your gross margin. But check this out. With variable costing, the whole format changes. You take your sales and you subtract only the variable costs. This gives you an incredibly powerful number called the contribution margin. It tells you exactly how much cash each sale is contributing to help you pay off your fixed costs. And then, after that, how much becomes pure profit.
All right, time to go back to the bakery and see these two methods go head to head in the real world. This is where it gets really fun, because when the number of loaves you bake isn't the same as the number you sell, the final profit number can be wildly different depending on which method you're using.
Let's start with June, a nice, clean month. The bakery makes 10,000 loaves and sells 10,000 loaves. No change in inventory. And look at that. The bottom line profit is exactly the same under both methods, $5,500. So far, so good.
But now let's look at July. They still make 10,000 loaves, but sales were a bit slower. They only sold 8,000, so inventory went up. And whoa, look at the profit numbers. They don't match anymore. Absorption costing says they made $3,900, but variable costing says they only made $3,000. What happened? Well, absorption costing tucked a piece of the month's fixed costs into those 2,000 unsold loaves, hiding it in inventory instead of expensing it.
Then August rolls around, and it's a fantastic month. They sell 12,000 loaves, clearing out all that extra inventory from July. And just like that, the tables have turned. Now, variable costing shows the higher profit. Why? Because absorption costing finally had to release those old fixed costs that were hiding in July's inventory, and that dragged down August's reported profit. So it all boils down to a really simple rule of thumb. When your inventory levels go up, your absorption costing profit will look higher. When your inventory levels go down, your variable costing profit will look higher. It all just depends on where those fixed costs are parked. Are they hitting your income statement this month, or are they sitting quietly on your balance sheet, inside your inventory?
So you might be asking, okay, which number is the right one? And why on earth should we care about having two different profit numbers? Well, here's the thing. It's not about which one is right or wrong. It's about what each number helps you do. And this is really why it all matters. Variable costing is an incredible tool for making decisions inside the company. It shows you the real-time cash impact of each sale, and it helps you make smarter choices. But maybe most importantly, it gets rid of a really dangerous incentive for managers to just produce a ton of extra inventory to make the quarterly numbers look good under absorption costing. That's a classic corporate game that can really destroy a company's value in the long run.
And look, this isn't just some abstract academic exercise. In the world we live in today, being fluent in these cost concepts is absolutely essential. Mastering these tools gives any manager, any leader, a huge advantage in generating real value and making smarter, faster decisions.
So we'll leave you with this question to think about. Absorption costing is the official story, the one you have to tell the outside world. But very often, it's variable costing that tells the truer story of your company's day-to-day operational health. Deciding which story to listen to when you make your own decisions, well, that's the mark of a really savvy business leader.